Prime Minister says this is something that has been hiding in plain sight for months. But if it does come together, it would be the second largest trading bloc in the world.
$5.8 billion halted, 1,600 American jobs frozen, $19 billion accelerating into Canada. In the middle of a fragile trade war climate, the United States just lost one of its most strategic electric vehicle investments. Ford Motor Company has canceled its Blue Oval SK battery plant in Kentucky, a facility designed to anchor American electric vehicle independence. Canada is advancing nearly $19 billion in coordinated battery investments across Ontario and Quebec, positioning itself as a stable alternative inside North America. This is not just a canceled factory. It could be the first fracture in a massive industrial loss for the United States during the trade war era. Today, I will expose the real scale of the damage, the hidden capital flight, the long-term manufacturing losses, and the strategic shift toward Canada that has never been fully revealed. The cancellation of the $5.8 billion Kentucky battery facility did not stop at one construction site. It triggered a reassessment inside capital markets about the long-term stability of industrial investment in the United States during an ongoing trade war environment. When a project of this scale collapses after policy reversal, institutional investors recalibrate risk exposure across the entire sector. Battery manufacturing is capital intensive, often requiring 7 to 10-year financing horizons and billions in fixed infrastructure. Even a 1 percentage point increase in weighted average cost of capital can add hundreds of millions in lifetime financing burden to a single project valued above $5 billion. When political volatility becomes embedded in pricing models, projects that once cleared return thresholds no longer qualify for approval. This is how capital flight begins quietly. If just 3 additional large-scale battery facilities reconsider United States expansion due to policy uncertainty, the cumulative exposure could exceed $15 to $20 billion in deferred or redirected investment. That does not include supplier ecosystems, grid infrastructure expansion, or downstream manufacturing tied to those plants. In a trade war climate where tariff exposure already pressures margins, added regulatory uncertainty compounds risk at scale. Meanwhile, Canada is executing a coordinated $19 billion battery expansion strategy across Ontario and Quebec. Investors interpret that framework as multi-cycle durable, not election dependent. In comparative models, lower volatility reduces risk premiums, allowing Canada to attract long-term capital at more favorable financing terms than the United States. The labor implications deepen the severity. The 1,600 displaced Kentucky workers represent roughly $110 million in annual payroll at prevailing skilled technician wages. Applying conservative regional multipliers between 2.5 and 3 total economic activity, impact may approach $300 million per year. Over a 5-year period, that exceeds $1 billion in suppressed regional output from a single halted facility. If similar volatility slows even 10% of projected advanced manufacturing growth nationally, the broader macroeconomic cost escalates into the tens of billions over the decade. Reduced payroll circulation weakens municipal tax bases, strains infrastructure repayment, and suppresses small business formation. Industrial contraction rarely appears as a single collapse. It spreads through secondary and tertiary economic channels. The strategic risk extends beyond jobs. If Canada consolidates between 35 and 40% of North American battery production capacity by 2028, while the United States remains below 20%, supply chain leverage shifts materially. American automakers could face pricing premiums of 10 to 15% during constrained capacity cycles. On mid-range electric vehicles, that translates into several $1,000s in margin compression per unit. Consumers ultimately absorb that pressure through higher prices or reduced model availability. In a prolonged trade war era, supply chain concentration equals negotiating power. If Canada becomes the dominant continental battery hub, the United States may retain consumer demand but lose upstream control over core electrification inputs. That dependency alters bargaining dynamics not only in automotive trade discussions, but in broader industrial negotiations. The deeper concern is reputational. Global capital allocators do not forget abrupt reversals. Once the United States is priced as a jurisdiction with elevated policy volatility risk, restoring confidence requires years of uninterrupted stability. Canada, by contrast, benefits from comparative predictability without needing to match the sheer economic scale of the United States. What makes this moment particularly dangerous is the compounding effect. When one $5.8 billion facility halts, investors reassess similar projects in hydrogen systems, grid storage, semiconductor back-end assembly, and critical mineral processing. If even a fraction of those sectors adopt a defensive capital posture, the long-term industrial cost multiplies quietly across the economy. The Kentucky decision may ultimately represent only the visible portion of a much larger capital reallocation underway inside North America. The financial exposure now forming beneath the surface of the trade war environment could reshape manufacturing leverage for a generation. The most dangerous consequence of the Kentucky cancellation is not the immediate loss of $5.8 billion. It is the structural dependency that may now begin forming beneath the surface of North American manufacturing. In a prolonged trade war environment, production concentration determines negotiating power. Battery production is no longer a niche industry. It is the backbone of electric vehicles, grid storage, heavy equipment, electrification, and elements of defense modernization. If Canada consolidates between 35 and 40% of North American battery output by 2028, while the United States remains closer to 20%, bargaining leverage shifts permanently. That shift affects pricing, supply allocation, and industrial influence. Even a 10% differential in battery contract pricing can materially alter vehicle margins in competitive markets. For high-volume models, this could mean thousands of dollars per vehicle in margin compression or retail price adjustments. In a trade war climate already shaped by tariff exposure, layered cost pressure compounds rapidly. The United States risks retaining demand while losing upstream control. Canada's industrial strategy is not built on scale alone, but on coherence. Federal and provincial governments aligned incentives, infrastructure expansion, workforce development, and long-term industrial signaling across multiple years. Investors reward that continuity with lower perceived risk premiums and stronger capital commitments. Capital does not require perfection. It requires predictability. Human capital migration may accelerate this shift. Skilled technicians trained in Kentucky and other United States facilities cannot remain idle indefinitely. Canadian manufacturers, particularly in Ontario near Detroit, operate within close geographic and cultural proximity, reducing relocation friction. When workers relocate, they carry institutional knowledge. Expertise, density determines innovation, velocity. When engineers, robotics specialists, materials scientists, and technicians cluster around expanding facilities, productivity accelerates. If those clusters increasingly form in Canada, research partnerships, supplier headquarters, and venture capital ecosystems follow. Industrial gravity then becomes self-reinforcing. The United States has faced this pattern before. In the 1990s and early 2000s, semiconductor fabrication capacity gradually migrated toward East Asia due to sustained policy alignment abroad and cost uncertainty at home. Rebuilding domestic fabrication decades later required enormous subsidy commitments and remains incomplete. Battery manufacturing may now be entering a similar inflection point. The trade war adds another layer of vulnerability. If cross-border supply chains become concentrated in Canadian facilities, while tariffs remain fluid between global trading blocs, the United States could find itself negotiating from a position less dominant than in previous decades. Dependency does not announce itself dramatically. It compounds incrementally. $5.8 billion halted today may influence $50 billion in allocation decisions over the next decade. Municipal fiscal implications also intensify. Regions anticipating long-term payroll growth tied to advanced manufacturing may face slower housing expansion, reduced retail activity, and strained infrastructure amortization. Canada conversely, could experience payroll expansion, strengthening provincial revenues, and public investment capacity. Economic asymmetry gradually becomes structural. The larger strategic question is no longer whether the Kentucky plant can reopen. It is whether multinational boards now model the United States as a higher volatility jurisdiction relative to Canada. Once that perception embeds into capital allocation frameworks, reversing it requires sustained stability across multiple election cycles. Reputational erosion is slow to build and even slower to repair. If Canada becomes the continental hub for advanced battery production, the United States may continue to assemble vehicles but rely increasingly on Canadian upstream components. That redefines leverage within North America during a period already defined by trade war tensions and supply chain recalibration. The shift would not represent collapse. It would represent dilution of dominance. And in the final phase of this analysis, we examine the long-term industrial reckoning, whether this moment becomes a temporary correction or the starting point of a decade-long hollowing of advanced manufacturing power inside the United States, a scenario whose full economic cost has not yet been calculated publicly. What began as a $5.8 billion plant cancellation may become a defining inflection point for advanced manufacturing in the United States. Industrial power does not disappear overnight, but it can erode quietly when capital loses confidence in policy continuity. In a prolonged trade war environment, continuity becomes as valuable as scale. The United States remains the largest consumer market in North America. That demand gives it leverage, but demand without upstream control weakens bargaining position over time. If battery production capacity consolidates in Canada, supply concentration shifts contract power northward. Supply concentration equals influence. If Canada reaches or exceeds 40% of North American battery output by the end of the decade, while the United States lags significantly behind, supplier ecosystems will reorganize accordingly. Cathode processing, recycling infrastructure, mineral refinement, and research laboratories gravitate toward capacity centers. Capital follows operational density. That shift becomes self-reinforcing. The risk for the United States is not immediate collapse. It is strategic dilution. When multinational boards begin modeling future investments, they incorporate volatility history into long-term risk assessment. Even modest increases in financing costs or regulatory uncertainty can eliminate marginal projects worth billions. Over 10 years, those eliminated projects accumulate. If multiple $5 to $10 billion facilities are redirected or deferred due to perceived instability, cumulative capital displacement could reach tens of billions across the decade. Each deferred plant suppresses regional payroll, reduces tax base expansion, and weakens local supplier formation. The long-term opportunity cost may exceed the headline cancellation itself. The trade war context magnifies this vulnerability. When tariffs, cross-border supply chains, and geopolitical uncertainty already shape industrial decisions, adding domestic policy volatility compounds investor hesitation. Manufacturers diversify risk geographically. Canada, operating inside the same continental market but with stronger perceived policy alignment, becomes a logical hedge. Hedges become hubs over time. Labor migration deepens the structural shift. Skilled battery engineers and technicians represent years of training investment. If expanding Canadian facilities attract even a portion of displaced United States workers, expertise density relocates. And expertise density determines innovation velocity. Once research partnerships align with growing industrial corridors in Ontario and Quebec, universities and venture capital networks reinforce that growth. Within 5 to 7 years, Canada could host not only production scale, but decision-making authority within the North American battery ecosystem. That would redefine continental industrial influence. The question is no longer whether the Kentucky facility restarts. The deeper question is whether multinational manufacturers now consider the United States a jurisdiction requiring higher risk premiums in long-duration manufacturing commitments. If so, financing spreads widen and project pipelines shrink incrementally. Incremental shrinkage becomes structural erosion. The United States still holds immense advantages: engineering depth, capital market scale, and consumer demand. But in the trade war era, those strengths must be paired with predictable policy execution. Without that alignment, capital allocators rebalance exposure. Canada's rise in this sector is not based on size. It is based on stability. If the current trajectory continues through 2028 and 2029, historians may identify this period as the moment when North American industrial leadership began to bifurcate. Not through dramatic confrontation, but through contrasting approaches to long-term commitment. One nation treated electrification as sustained industrial strategy. The other treated it as reversible policy. Capital responded accordingly. The final and most uncomfortable reality is this: rebuilding lost industrial ecosystems costs significantly more than maintaining them. If advanced battery production clusters consolidate in Canada, reversing that gravity could require extraordinary subsidy frameworks and years of uninterrupted stability in the United States. And that may be the hidden cost few policymakers are openly discussing. The cancellation of the $5.8 billion Kentucky battery plant is not simply a corporate adjustment. It is a stress test for the industrial credibility of the United States in the middle of a volatile trade war era. Canada has positioned itself as predictable. The United States remains powerful, but increasingly cyclical in its industrial signaling. Investors price that difference, workers feel that difference, communities absorb that difference. If battery production capacity consolidates north of the border, leverage shifts. If leverage shifts, contract power shifts. And in a sector that defines the future of transportation, grid storage, and advanced manufacturing, that shift carries generational consequences. The question now facing policymakers and investors is direct and unavoidable. Is this a temporary correction inside the trade war cycle or the early stage of long-term industrial erosion for the United States? Because once capital ecosystems relocate, reclaiming them becomes exponentially more expensive. This is not just about one factory. It is about who controls the next decade of North American manufacturing. Subscribe for more fact-based global analysis on the evolving balance between the United States and Canada. Thanks for watching.